Hello and welcome to my channel. I am Todd Allyn, and I really appreciate you spending time to come to my channel to check out my content. Please press subscribe and also the bell so that you can be notified when I have new content, and that also allows for the algorithm to reach other people as well, because I think that this information is important, and we'll get right into it. So, as you know, the Federal Reserve, the Central Bank of the United States, increased rates by 0.75%. And what I would like to do with this video is to tell you what I believe the impact would be on John Q. Public moving forward. So I would like to share my screen here and get started with this PowerPoint so I can show you. Hope this is coming in okay. All right. So we will talk about monetary policy. Anytime that the Federal Reserve or the Central Bank of the United States sets policies, this is called monetary policy. And we're going to talk about what happens when rates go up. So the Federal Reserve with monetary policy is responsible for the money supply as well as employment. And they use three tools to kind of manage the money supply and employment. They use reserve requirements. Now, reserve requirements are the requirements that each Federal Reserve Bank has to have a certain amount of reserves or a certain amount of money in their vault. And so the reserve requirements is that for every dollar deposit, how much of that do they have to have on reserve and how much of that they can actually loan out. Open market operations is when the Federal Reserve sells or buys bills, bonds, or notes. Bills are short-term investments, bonds are medium-term, and notes would be longer term. And so the buying and selling of those instruments will either increase or decrease the money supply. And the Federal Reserve rate is the rate that banks borrow money from each other. Now, you may be asking, why would a bank need to borrow money from another bank? Well, go back to reserve requirements, that for every dollar deposited, they have to have a certain amount of money in reserves. So what happens if you have a bank that at the end of business, they take a look and they see that they're not meeting their reserve requirements? What they would then have to do is go to what's called the discount window, and they would have to borrow the necessary money from other banks who may have excess reserves. The discount window is an overnight bank borrowing rate from bank to bank. And so the rate that the Federal Reserve is actually manipulating when they talk about a rate increase of 0.75% is this federal funds rate. And this may have some impact on borrowers at their individual banks, but the federal funds rate is the rate in which the Central Bank of the United States manipulates in order to either increase or decrease the money supply. In this case, we'll see what the impact would be with the way that they raise the rates. So again, the money supply, the amount of money that we have in circulation. Right now, the United States is facing inflation. And so inflation means that there's too much money in the system chasing too few goods. The reason why the goods are increased in price is because there's a high demand for those goods. High demand, a lot of people have the money for it, but then there's a little bit of the supply. So what happens is that the prices go up in order to kind of weed out different entities or different factions within the market system. So too much money chasing too few goods. And so the effect of that is that it reduces your purchasing power. Even though that you may have the money to buy it, it reduces your purchasing power because prices rise. So you can't get as much. And so your money does not go as far, and you end up having more month than money. And that's what happens in many instances when we have inflation. And I think gas prices have hit $5 or so. And so people are starting to see that there's not enough. And then you have the president, which says that it's the fault is the war in the Ukraine. Well, that may have some impact in terms of the amount of oil that may be available globally, but that does not mean that the United States cannot or does not have the ability to to produce oil. That's a whole nother video. So what happens when the Federal Reserve increased interest rates? Well, the Federal Reserve increased interest rates by 0.75%, as I said. So that means that banks have to pay more money to borrow money. That also means that the Federal Reserve is contracting the money supply. It says too much money is out there. We're going to reduce the amount of money that's in the system. So what's ahead? Well, that means that banks will not have as much money available to loan. So it's going to be harder for people to get loans to buy homes, to buy cars. They're going to need higher credit scores in order to qualify. This also means that businesses may not be able to get the necessary funds that they need for improved processes, improved efficiencies. They may have been trying to create efficiencies so that they can actually have better goods and services for their customers. They may not be able to do that anymore. It also may mean that unemployment may start to creep into the system as well. As we saw on the other slide, that the Federal Reserve, with monetary policy, they also had tried to keep an eye on employment as well. So what we see is that with an increase in rates, drying up of the money, businesses may not have the resources to pay salaries. And so you may see unemployment start to creep in. People at the margins or people at the lower incomes are going to suffer. Why? Because they may not necessarily have the necessary requirements to be able to get loans that they need. Businesses, again, are going to suffer. So we see that this is not headed to a good place. But let's do the math real quick, and bear with me on this. Even though that the Fed said a 0.75% or 0.75 basis point increase, let me show you what that actually means. So let's take on the left-hand side here, a rate increase example. You have something that was 10% and now it goes to 12%. Well, from 10% to 12%, many people will say, well, it's only a 2% increase. No, it is not. You have to take the 12, subtract the 10, and then you divide it by the 10. That gives you 0.20. You multiply that by 100, that gives you 20%. So from 10% to 12% is a 20% increase. So let's talk about the actual rate hike. Went from 1% to 1.75%. Doing the math, it's 75%. So the interest rates increased by 75% overnight with the stroke of a pen. Now, ask yourself this question: what has happened with your wages? Have your wages increased at any particular point? Well, let me answer that for you. Over the past 2 decades, wages have not risen very much at all. I think, in fact, if you look at the median income, and I'm just going off of my memory here, median income 20 years ago was 31,000, meaning that half the people had above that amount, half the people had below that amount. And so it was 31,000. Today, 2022, it's 34,000. So you think that it's probably a $3,000 or $4,000 increase over the past 20 years. Not a lot of money. It's less than the 75% increase that you just see here, for sure. So what's happening is that interest rates are increasing, but wages are not keeping shape or keeping up with the increases. So we may be having some trouble coming ahead. What's next? Well, if Congress raises taxes, and you hear this all the time from certain parties or certain groups of people, that people have to pay their fair share and that tax cuts are for the rich. And so what they may do is they may want to increase taxes. Well, the truth is that poor people don't pay taxes, and that the wealthier segments of the population do in fact pay taxes. And I think the last information that I saw is 50% of tax payers, or 50% of tax, or let me back that up. 50% of all taxes, 100% of all taxes are paid by 50% of the population. That's better. 100% of the taxes are paid by 50% of the population. So if we see that Congress raises taxes, and we also see that this tax rate increase, we may be in for trouble. We may be headed for a recession. So if they cannot control spending, or if they increase taxes, it may not be good. So that's my synopsis of what is taking place and my outlook in terms of what we were seeing. So I think it's very important that you stay diligent in terms of watching your resources. And at this particular point in time, you may want to take a look at some options. You may want to start that business that you've been thinking about. That at this particular point in time, it looks, I believe, within the next several months, that the United States economy will be slowing down for sure, and we may see unemployment start to show its ugly head. So, with that, if you have any questions or comments, please feel free to reach out to me, to email me, or to text me, or email me, I should say. If you follow me on Instagram, or if you follow me on TikTok, you certainly can message me, and I will be sure to include answering your question in the next videos. But again, I'm Todd Allyn, also known as Professor Econ. Thank you for watching, and be blessed.